Welcome to the Referrals Podcast, the show designed to help everyone from the solopreneur to the Fortune 500 company win the referral game. If you want to build a company with an army of ambassadors and raving fans who speak highly of you and refer you willingly, you are in the right place. And now, here is your host, Michael J. Maher.
Hey, everybody, it is Michael J. Maher with another episode of Referrals Podcast. Oh my gosh, 200,000 downloads at this point. That is, who's downloading this? What else are you doing? Don't you have anything better to do than to download Referrals Podcast? This is crazy. I have to tell you, actually, I just want to say thank you to everybody who has made Referrals Podcast so popular. We are trending in the United States, Canada. We're trending in the UK. We're trending in Singapore. We're trending in China. We're trending in Japan. We're trending in the Netherlands. We're trending. Really? Wow. You know, I have to say thank you to everybody. It has been amazing. I mean, if you would have told me if we didn't use the word marketing in our title that we would be so successful, if you told me we didn't use somebody's name in the title that we would be successful, I would have thought you were crazy. It's referrals. It's one word, referrals. Are referrals really that popular? Are they really that desirable? It looks like this is the future. This is the light. This is the way right now. And I will tell you, if anything has come about from the quarantine and the stay-at-home orders, is that if you haven't been building relationships and you haven't been building your army of ambassadors, you probably fell behind. But if you have been, then you actually are setting records in your business. I literally just got off a call with a lender, record March, record April, record-setting May, record-setting June for her entire career, 20-year career, record-setting July, record-setting August already so far, with another bunch of million already lined up for next month. So the bottom line is, you know what? Implement the 7L system. Do it with relationships. Do it with referrals. People are going to lead you down that road. I will tell you, speaking of people, I've got to give a shout out to somebody who gave us a great review on Referrals Podcast on iTunes. This is an iTunes review from Wheels on One. This podcast has been a blessing for me. Wow. Helps me to change my mindset towards my business and my life. Thank you, Michael J. Maher, and guest from a very grateful listener. And I will tell you that I love today's episode because we're gonna tell you about things you probably should be thinking about, but aren't. Like, how would you like to retire someday? Like, literally, or be able to retire, even if you don't want to retire, you'd actually be able to. You have a choice of retiring. You know, realtors out there, a big part of the episode today is for you. I love you. And I want you to know that old realtors don't die. They just become listless. If you didn't get that, then you're not a realtor. But I will tell you that it is one of those where, we hear of the story of the 94-year-old realtor. It's great. If you're a realtor, you're never going to quit doing real estate once it's in your blood. But what if you could? What if you didn't have to worry about? What if you had these financial instruments in place to such that money was no longer a worry, that you didn't have to sell something to buy something, right? That you already had everything you needed in place. You had the systems in place that your business was running. The systems in place for your finances were fine. You know, I will tell you, that's what we have on today. And I am very excited to, believe it or not, I'm very excited to have a certified financial planner on. Can you believe that? Most financial planners it's like talking to a clock. It's like, are you kidding me? Like, so boring. This guy, he's on the other end of the spectrum. I can't wait for you guys to meet him. His name is Dan Cuprill. He is a certified financial planner, and he's president of Matson and Cuprill, a wealth coaching firm located in Cincinnati, Ohio. He is a graduate of the University of Iowa, where he earned, and he also earned an MBA from Northwestern University. His firm specializes in helping people prepare for financial independence by employing a holistic planning system called Retirement Rescue. He is the author of several books and the host of the podcast, which you need to check out, called The Profitable Advisor. Dan and his wife, Beth, split their time between Cincinnati, Ohio, and Franklin, which is outside of Nashville, Tennessee, and maintain offices in both cities. Our guest today is certified financial planner and wealth advisor, Mr. Dan Cuprill. Dan, welcome to Referrals Podcast.
Michael, it's a pleasure. You've got me very fired up, and I'm very excited to be on here. I'm honored. So thank you for having me.
Come on, it's like, we've had financial planners who are like, hey, we'd like to be on, and, we'd love to be part of Referrals Podcast. We run our business by referrals, and by like 3 minutes in, like I'm yawning. And it's like, oh, come on, and then, we know you through referral and like, you can actually like give us like the juice and the structure in a way that, I hope that our listeners take action on. That's what I really hope, because, we've taken a lot of your advice or advice from that is similar to what you're advising. And it has really set us up to be financially independent. And I would even call us financially interdependent in some ways, but it's one of those where I just love that today we're talking about something that many people like don't think or talk about until it's too late.
Well, and let me,
right?
You mentioned something about the 80 or the 94-year-old realtor. And in our world, there's something similar to that too. There are financial advisors who are going out at 85, 90, but here's the reality. They're not doing it because they want to do it. They're doing it because they have to do it. I mean, one of the dirty little secrets is that a lot of financial advisors are like dentists with very bad teeth. They're not practicing what they preach. And when I look at small business owners, particularly realtors, where so much of their revenue is one-off, they don't have, unless they have intelligently built a portfolio of rental units, so many realtors, it's just transactional. And as a result, they've never really had a system in place for building their wealth. Look, you can call me a hardened capitalist. I believe that one of the major reasons, in fact, for me, the major reason for becoming self-employed was to build my own wealth.
That's right.
I felt I could do that greater. And I believe that there were so many great things that could come that I could help other people if I was financially independent at a relatively young age. And realtors have this very same power of doing it too, but they've got to focus on more than just where's the next sale coming from. They have to think more like business owners in order to do that.
Yeah. So let's jump right in. I have to tell you, I've gotten so many compliments on the Referrals Podcast, and don't take offense to this, but this is in general. I don't say, well, tell me how you got started in financial planning, right? And tell me your story. Like, tell me about your high school days and it's like, we don't go there. Here's the thing. We are interested. Anyway, right? Yeah. Right. Well, I mean, I do have some care, but the thing that everybody loves is like, I jump right in, which feels a little weird to the conversation, but it delivers the most juice. It delivers the most, the value in the shortest amount of time. And so I'm going to ask, like, right off the bat, like, what's the biggest mistake that you see solopreneurs or business owners, self-employed business owners, or realtors or lenders? Like, what's the biggest mistake that you see them do from a financial standpoint?
Okay, there's actually two, and they're equally as damaging.
Okay.
The first one is they don't understand how to legally structure their business.
Okay.
Too many solopreneurs are really just operating as sole proprietors. And when you do that, you maximize the taxes that you're going to pay. You also make yourself a lot more vulnerable from a legal standpoint. Realtors, if their states will allow, and I frankly don't know of any state that doesn't allow this, should set up at the very least in what we call a limited liability corporation, where they are filing as a subchapter S. What that means is that when you look at your income coming in, you can take a salary for part of it, and the rest of it can be treated as a dividend. Why do you want to do that? Because you don't have to pay payroll taxes on dividends. And that can be a huge savings depending on how big your practice is. But too often they're not doing that. And so they're paying payroll tax on everything. And when you add it all up for a self-employed person, that's 15.3%.
That's
a lot of money.
Brutal. 15% on a good income, right? I mean,
Exactly.
that's a lot of, that's $15,000 on $100,000. It's ridiculous.
It's really
that's
just
ridiculous.
a matter of structuring it properly with your accountants so that you're legally filed that way. It was set up to help small business owners, but the government isn't going to force you to do it. No one at the IRS is going to call you and say, you know, you really don't have to operate as a sole proprietor. That's on you. And I've seen that mistake time and time again. Now, it's becoming less so. I am seeing more realtors awake to that. Word's getting around. But I got to tell you, as our country continues to print money, my biggest concern is taxes are going to rise. Mm-hmm. So you have to structure one way to minimize your taxation. The other thing is that there really is no plan when they start the year. They have a marketing plan. They have a selling plan. They have a plan on how many homes they're going to do. They've never really had a profitability plan. They've never predetermined when the year began that if they hit maybe their last 5-year average in revenue, how much of that money was going to be set aside long term. The way that I always tell small business owners to do it is, look, let's say, for example, we can agree that you're going to set aside 10% of revenue. That means every time you get paid, every time, I don't care if it's $50.
Yeah.
Automatically 10% of it leaves your business account and goes to your investment account. Automatically. If you give up 10% of anything in life, you will not miss it.
Yeah.
Anything bigger than that, you might. But 10% you can do with it just fine.
Yeah.
And so what you have to do is have a profitability plan. And a profitability plan says profit's not something that comes at the end of the year. Profit comes throughout the year by making sure that every time I get paid 10%, I don't even see it. But if that money goes in the business account, it's going to get wasted. And this is why we see 95-year-old realtors.
So we're 5 minutes in, and we've already saved somebody $15,000, and we've reminded them to have an investment account where they put 10% in. Like, we could drop the mic and be done. I'm not even kidding. But I have to tell you, I guarantee you that there are realtors and there are self-employed business owners who are not set up as an LLC and flow it through a substructure S, right? I guarantee, and if they just did that, it would save them thousands and upon thousands. I can't even imagine how many hundreds of thousands of dollars this has saved me over 20 years. So I love that. And then you're talking about the profitability plan. What is, and you're exactly right. 10%, you put it in an investment account or a savings account or whatever it may be.
Well, even better. I mean, look, you as a self-employed person, you can set aside as much as a fourth of your income, up to about $60,000 pre-tax.
Mm-hmm.
So
pre-tax.
Yeah. So we talk about saving money, but what wouldn't it be great if we didn't have to pay any tax, at least in the beginning, as that money goes in? So you can dramatically lower your taxes that way as well. Now, look, people who have regular jobs, who work for companies, they do this all the time and they don't even realize it because they get their paycheck and all the withdrawals and deductions and 401k contributions are made automatically. As self-employed people, we have to put the structure in place so that happens automatically as well. So again, if you had a system set up where every time a check comes in, a check goes out of 10% of that revenue and went into your retirement account, by the end of the year, along with the LLC, you're going to find you're having major tax savings that year.
Yeah, huge. Right. And I have to tell you, when I first started in the business, I became successful very quickly. The problem was I was not an LLC and an S Corp. I was a sole proprietor at that time. And I remember making like nearly $1 million and having a tax check to have to write of $300,000. I didn't have $300,000 to write. So I actually had to work with the IRS to pay my taxes over a year. Well, if I'm paying taxes from whatever the year that was in the next year and the next year, well, I'm also paying those taxes. So it's like, oh my God, I had better sell something because I had to pay my taxes. So it's one of those where it's like, thank God we learned some of these structures and also the financial acumen to pay that first. And then guess what? Live on the rest. Pay
Well, and
yourself
there
first,
comes,
pay the taxes first,
sure.
and then live on the rest,
But there comes another mistake that gets made, because
Yeah.
while maybe we are setting aside money for savings, you're right. People are forgetting taxes. So what you also need to have is a tax plan, which means if you know that your effective rate, after you factor in deductions and exemptions, if you know that's roughly 20% of revenue,
There you go.
then every time you get paid, 20% of that check needs to go into a separate account for taxes. You have to pay them as you go. If you wait until the end of the year, you're going to get hit up with penalties, interest, lien on future earnings. It's not worth it. But what happens is we develop this mindset that says, I'll sell a big house in December and that'll carry over the tax. Don't do that. In fact, enjoy your time with your family in December.
Yeah.
But you have to have this structure and the system in place. And that's why really, when you think about every time you get paid, you should automatically know what percentage needs to go towards business overhead, what percentage needs to go towards taking care of yourself and your family, what percentage to go to savings, and what percentage to taxes. And frankly, you should have 4 different bank accounts specifically for those goals.
So what are the 4 accounts again, just for review?
Okay, the 4 accounts, and this is not just realtors. Every business owner should have these. Number 1, naturally, you're going to have your business account. And that's the account in which most of your income is going to pour in. But that money should not stay there long. Secondly, you need to have your personal bank account, which you already have. But the only money that should go into the personal bank account is the money that you need to run your household. Third, you need to have your tax account. That should be a savings account, hopefully, preferably in a completely different bank than your other accounts, because you don't want to be able to rate it quite easily. And in there, you put a percentage of every incoming check that you get to pay your taxes. The last account is your investment account, designed to build your net worth. Now, if you have debt, you can just as easily take that money in the investment account and put it towards your debt, because for many people, the greatest rate of return they can get on their net worth is to cut their interest costs.
That's right.
Now, when I say debt, I mean like high interest consumer debt. I'm not talking about mortgage debt.
Yeah, you're talking about
But in
credit cards.
reality, your business account should only have the exact amount of money that you've predetermined with a budget, how much you need to run that business. Everything else should leave that account immediately. Otherwise, it will get wasted.
I love it. And so I want to reiterate for everybody, you have your business account that flows into a personal account, which is for your household. You have a tax account at a different bank so that it's harder to get to, harder to rate, or harder to use. You don't use that for your vacation, right? You use it for your taxes. And then you've got your investment account, which is in the beginning could be money goes in there and you pay off debt in the short term.
And if you set up like a solo 401k and take advantage of the LLC, your tax bill is going to go down dramatically.
Yeah. Love that. So, I think talk about that. Like, so what are some of the lessons, right, when it comes to saving for retirement that a solo, entrepreneur or a realtor should really be looking out for or should be doing?
Okay. The biggest lesson is to understand that life is not linear. Bad news happens and there's absolutely no way you can predict it. Where investors get burned is they react to market movement. So you just take this year right now, 2020. You give me the month and try to determine what kind of a year it's going to be income-wise, investment-wise. There have been months we've had here that have been record months, both for the upside and the downside. Here's the point. You're never going to know the news of the day before it happens. Investing is about writing it out. Now, emotionally, we don't like that. But we know logically it's all about buying low and selling high. So when the market crashed in the first quarter, for an investor, that was actually good news.
Right.
Why? You could go out and buy more shares.
Buy.
Right?
My son bought Amazon and he's almost doubled his money.
There you go. Here's the thing. So I was born in 1963. In 1963, the Dow was trading at 600. Think about that.
Wow.
Right?
Yeah.
So here we are now, close to 30,000 for a second time. I don't even know how many times it had to double to get to this point. But I do know this. From 1963 to now 2020, there's been a lot of really bad news. I mean, the 60s, the 70s, We had a little bit of good period there in the 80s and 90s, but even then we're dealing with the Cold War. We had AIDS. I mean, in fact, if you went back in a time machine and told people 1963 what the next 57 years were going to be like, they never would have thought that life that we live today is like it is.
That's right.
So as an investor, what you need to be focusing on is buying shares. Don't worry about the value of the shares. Buy as many shares and as diversified portfolio as you can. I always recommend index funds, and just focus on share accumulation. When you get caught up with the day-to-day or the month-to-month values, that's where people get burned because they end up buying high and selling low. Right. I don't want you to be ignorant, but I don't want you to be emotional. And when people are looking at their returns on a daily or monthly basis, emotion's getting in the way. They think they're being logical. They don't. The only way that you can logically buy and sell is if you get next week's newspaper today. You'll never get it.
Back to the future, baby.
So enjoy the ride. 600 to 30,000 in 57 years.
Yeah.
It's going to double again. In fact, for many, many years as an advisor, people would ask me, where's the market headed? And I would first say, I have no idea. And they were disappointed. And then I would say, oh, okay, I know where it's going. It's going to go to 25,000. Now, this is when it was trading at 10. Yeah. I just don't know when.
Yeah.
Well, I found out when that was going to be.
Yeah.
Well, now where's it going to go? It's going to go to 50,000. We just don't know when. It is only natural that it's going to double because that's the way life works.
Yeah.
But in the short run, it can get chaotic.
Yeah.
Don't focus on it. Just focus on buying shares.
Yeah. So let's say somebody's making 100,000 and they don't have any credit card debt. You know, they pay it off on a monthly basis or whatever. Right. And they've been putting money. So now they have this $10,000, right? Right. And it's in their investment account. And they're like, I mean, 10,000 doesn't feel like very much purchasing power.
It's not.
Like, and I don't know how much you can advise, right, in a podcast environment. And I don't want to have to put 5,000 disclaimers or lawyer tags at the end of this. So, but what are some options for that person who feels like a failure because they only have 10,000 in the investment account, but they have $10,000 in the investment account, right? Okay. So what are some suggestions? Because there's a lot of the realtors on there who are like, this is where they have to start. You know, and it's also, I'm gonna throw this out because it's addictive. Like your investment account, trust me on this, realtors, lenders, brokers, when you start putting this money away, it will become addictive. You will love seeing this account grow. I just want everybody to know that is once you do it, it does become kind of a lifetime habit that you will love. And it took me 3 years of chaos, right, before I did it. And I will tell you, as soon as I did it, I started making more money because I appreciated money. Before, I didn't appreciate money. It just came and went and so on. But what you appreciate appreciates. When you start to appreciate money, like a budget, like a tax account, like an investment account, all of a sudden you're going to make more money and you're going to have more money simply because you appreciate the money that you have. So it's interesting how that works.
Okay. So in general, so this is not direct advice to anybody. All right.
Yeah.
Speak to your advisor before you do this.
Yeah.
But the first thing I'm going to tell you is you need cash reserves.
Yeah.
See, where so many people get in trouble with debt is because they have no emergency account.
Right.
And I think strongly you should have at least 3 months of living expenses just set aside in cash. Don't worry about the interest it's not getting. Okay. Yeah. At least it's not going negative.
Yeah.
If it goes negative, then you can keep it in the vault in your house. But you have to start off with cash reserves.
Yeah.
After that, follow the 10% rule. 10% of everything you make, invest. Now, where should you put it? Well, look, in the long run, equities are always going to be better. Stocks are always going to be better. Where people make mistakes is they try to do two things. They try to stock pick and they try to market time. They try to figure out what stocks are going to go up higher than the average, and they try to figure out what's the market going to do before it does it. All right. Unless you have information that nobody else has, you will never be able to skillfully determine which stocks are going to go up. If you read about it in the Wall Street Journal, that means the whole world knew about it yesterday.
Yeah, a week ago.
Right? Buy the index. When you buy an index fund, you own the entire market with the lowest possible cost. You lower your costs, you increase your return. Depending on how you do it, you could have 15,000 companies by investing as little as 5 or 10 grand.
Yeah, that's awesome.
So be smart that way. All right.
Yeah.
Secondly, don't try to get cute. Don't think you know what the markets are going to do before they do it. You won't. And study after study shows that the attempts to outfox the market produce much lower rates of return. You're going to get damaged more by being out of the market when it goes up than you will ever be being in the market when it goes down. Why? Because when it goes down, it comes back.
Yeah.
But if you're out and it's already moved up, it's too late.
Yeah.
So I don't want you to be an ignorant investor. I want you to be a systematic investor. And like you said, if you could just put the side every month, you have it set up where it automatically comes out of your account every month, and you start getting that statement. And my thing is I'll tell people all the time, try not to look at the value per share. Just look at the shares. Look at the number of shares you own. Because you know what? When the market goes down, that same $1,000 a month will buy more shares.
That's right.
We call that dollar cost averaging. Yeah. So in a really weird way, as a long-term investor, I want the markets to go down because I get to buy more shares. I know
prices.
Right. Now, I know in the long run, it's going to go up. It's always been the case, at least. Short of a nuclear bomb, probably. It will always be the case.
Yeah.
But in the short run, no, I'd rather buy things on sale all the time.
I love it. Explain dollar cost averaging to the people that might be new to the term.
Sure. So let's say you've got, let's use a number I can do easily in my head. Let's say you've got $12,000. You already have your short-term cash reserves, and now you're looking to put $12,000 into stocks. And let's say you decide, okay, I'm going to put an index fund. Well, you have a choice. You could put it in all at once. Let's say it's the 1st of January. Or you could break it up into 12 installments. Now, if you break it up in 12 installments, let's say the market goes down throughout the year and then starts to come back up, just like this year. This is going to be one of the greatest dollar cost averaging years of all time because we had a major decline and then it came back up. So every month as the market's going down, you're keep putting your $1,000 in, but your average cost is going down because you're buying more shares on the cheap. So if the market finishes, let's say the market starts.
All right, hold on. I'm going to stop right there real quick. So if let's say the shares were $100, they went down to 30 in March, right? Well, if you had $1,000, you're getting 330 shares instead of getting 100 shares. So you're getting almost 3 times as many shares, even though you're investing the same amount of money, right?
And if the market finishes at the end of the year where you started, you will have made money.
Right.
So you think about it. Yeah, if it's trading at $100 a share on January 1, and I put all the money in, and on December 31st, it's $100 a share, I haven't made anything. But if I break it into $1,000 installments, and let's say it does drop, but then comes back, I make money even though the starting values and the ending values were the same.
Because you got more shares.
Now understand this. In a short run, that's a bit of a coin toss because I've seen many years where dollar cost averaging in 12 months worked against you. Over the course of your life, it should work really well. But look, if that's what it takes for you to get started, fine. Put it in monthly increments.
And the power of it is that it's a system. You know, if you're putting 1,000 in every month for your life, then it's a system. So the fact of the matter is it's probably going to work for you. But the other part of it too is you don't have to think about it. If you have to think about stocks and you have to try to market, if you're trying to time the market, or you're trying to buy low and sell high and everything else, then you're thinking about it. And the problem is when you think about it, you're always going to get it wrong with the stock market. I mean, it's just how it's going to be, right? I mean, it's like you can judge like Amazon's probably going to go up, right? But
over time, it almost has to go up. Okay.
Yeah.
But in the short run, Jeff Bezos could die tomorrow.
Yeah.
Jeff Bezos dies tomorrow. I guarantee the price drops. Now, if you knew he was dying before anyone else knew, you could make money off of that.
Yeah.
Right. But you don't.
Well, he is dying. Right?
Well, we all are, right?
Right. Exactly. So he will die. Right. We were talking earlier.
We all will die eventually. Right.
Death, taxes, and what was
right?
I can't remember the other one. So
probably insurance premiums.
Yeah,
now,
that's right.
Here's another thing I want to point out to realtors, especially. You know, when you're selling a house, that a house is only worth what someone's willing to pay for it, right?
Right.
I mean, you can put it up there and you probably say this to your clients all the time. Yeah, you think it's worth 700,000, but unless someone shows up for 700, if the highest offer you get is 6, the house is worth 6. I'm sorry, that's just the way it works. It's the same way in stocks. Yeah. Something is worth what someone's willing to pay for it. Therefore, when you hear things like a stock is overvalued, there's no truth to that at all, because there was just a transaction literally that day that got it to its current price.
Right. Now, somebody paid that, so it's worth that.
Now, if there's some new information that comes out, fine. But unless you have that information, it's pure speculation. Don't speculate. One other thing I want to talk with you about realtors, because one of the problems I see about the real estate industry is that too many realtors are dependent solely on the sale, the transaction. It's one of those businesses where, by design, it doesn't give you recurring revenue unless you expand and become a real estate investor. And I highly recommend realtors think about that, because there's nothing more valuable than recurring revenue, to get the same revenue every month from the same group of clients. So sure, go out there and sell homes, but you know as well as I do, you don't know when that person's going to be ready to sell a home again.
Right.
But if you can also build a portfolio of rental units, for example, where you're going to get consistent income, that's smart. And that's how you use your expertise as well. So think about that. You stay in your current industry, but nothing's more valuable than recurring revenue.
And I want everybody to recognize like what just happened right there. This is why we love Dan Cuprill, right? Is because like 99% of financial advisors are going to say, maybe not 99%, 90% are going to say, put it all in stocks, put it all in stocks. But if you're a realtor and you really know your market, and you really know a property could be had at a good price and rented at a good price, why the heck wouldn't you buy it? And why the heck wouldn't you use your knowledge, your most current and accurate knowledge, to better your own wealth? You know, I will tell you that that has been a centerpiece of our wealth building for 20 some years, is investing in real estate, you know, and it's saved our butt at times. And yes, occasionally it's been a headache, but
well, like every investment will be. Every investment will have those moments. And, you know, now be careful. I do get concerned when I see an investor has all their money there. And the reason I have a problem with that is because there is a liquidity issue with real estate. Sure, the rents are great. But if you have to sell principal, if suddenly you have a high vacancy rate, it can be problematic. So you have to diversify. But if you know what you're doing and you're in that industry, why wouldn't you do that? But more than anything, every business needs a level of recurring revenue to be able to sustain itself. Otherwise, it's feast or famine. And, you know, look, if it would be great if you're still selling homes at 85 and you've got $500,000 coming in off your rentals.
Right.
Okay, fine. You're selling them because you love them.
Yeah.
Great. Don't do it because you have to do it.
Right. I love that. And, you know, they've heard me on this show before talk about the 6 months of cash reserves, right? Have 6 months of cash, you know, and you want that above and beyond anything else, in my opinion.
You do.
Like
no, you absolutely
before you
do.
invest, even before, you know, even before you get a rental property, is just have that 6 months reserve. Know what your monthly nut is. Have 6 of those in your pocket somewhere, you know, getting 1% or 2%, some super low rate.
At least it's not negative.
Right. Yeah, exactly. Well, if you really look at inflation and some other things, it might
be.
No,
that's true.
But it's, you're right. I mean, it's there, and it's probably a safe bet to get you through 6 months. So, but I will tell you, I love the thought of investing in real estate, investing in the index funds, and you've got this portfolio. It feels really small early on, but later on you check it, and boy, you've got 10 or 12 properties over here. You've got the index fund plus some individualized stocks over here that's under the guise of a fantastic financial planner, you know, and hopefully you've got a property manager over here who oversees your property portfolios, and what you do is whatever the heck you want. You know, that's a really, really good existence, you know.
And if you use during your working years, if you use your rental income to fund your portfolio, what a dynamic thing you got going. You're building equity value in the property, and you're taking the cash flow and you're using that to buy the stocks. So
Yeah.
you're going to get that diversification, but it doesn't become an either or game.
Yeah. And I love this. Love this whole line of conversation. We have a great download for everybody. You can check it out at referralspodcast.com. Also check out dancuprill.com, DANCUPRILL.com. You can get his daily email. And also he has a free download of his newsletter that's also out at referralspodcast.com. Let me ask you a point blank question. Is the heavy vehicle discount still a tax break out there?
No.
Is that so? The 6,000 pound vehicle, you can't write
Yeah.
that off as a realtor. That existed for a long time. I didn't know if it was still a
Yeah,
thing.
there was an administration that felt those weren't fuel efficient and environmentally friendly, so we lost that one.
Yeah. Yeah. So I wasn't sure about that. So
Yeah.
Very cool. And any other hints or tips for let's go realtor specific, for a realtor to maybe save on taxes or to build their wealth?
I actually want to kind of divert slightly and talk about
Yeah.
protecting your wealth a little bit.
Yeah, let's talk.
Because
Yeah.
one of the biggest problems, and realtors especially, because let's face it, you're an active person, is so many realtors do not have any type of disability coverage. And the likelihood of being disabled is far greater than dying up until about age 70. So if you're in that accumulation stage of life and you're self-employed, you know as well as I do, you can't work, you don't get paid. So it's important that you have that factored into your plan. I've seen some really sad examples where someone did a phenomenal job of accumulating wealth, and by the time they were 40, they became disabled, couldn't work for 5 years, and it was all gone.
Wow.
So be careful about that. Disability insurance is very important. It's a form of health insurance, essentially. Hopefully you'll never use it, because I always like to say the person who becomes disabled isn't beneficial, but you can deduct it. You can deduct it from your taxes. It may not be beneficial, because if you don't deduct it, then you can get the benefit for free, but tax-free. But it is something you need to be thinking about. We're all for accumulation, but we have seen bad things do happen, and they're not always permanent. But if you can't work for 2-3 years, and this is particularly true for women, the likelihood of most realtors are women, I believe, your likelihood of disability is statistically far greater than that of a man. So if you're the primary breadwinner in your household, you got to protect that income, and your sales will not be protected against disability unless you do something about it.
Yeah, I love that. We talk a lot with our coaching clients about playing offense and playing defense, and playing offense is go sell, sell, sell. It's invest in stocks. It's invest in real estate. It's kind of this offensive game plan. But you also have to have this defensive game plan against what could happen. Disability, an umbrella insurance plan, another good idea. And some of these things, and what's funny is that, you can spend 99% of your time playing offense. But the problem is most spend 100% of their time thinking about offense, and they don't spend any time thinking about defense. And you've got to think about defense at least one time a year. You need to set yourself up for the next year or next several years in case anything happens, like, disability, death, any of that. Just make sure that you're covered, right? Don't have nothing in place. Like health insurance, you got to have something. Even if your deductible is $10,000, or you have a cafeteria plan that you never use or whatever it may be. But it's one of those where it's like you've got to play deep. You've got to at least think about defense once or twice a year. But you can set yourself up for the whole year to where you don't have to think about it again.
Yeah. And look, the longer you live, the more likely something bad happens. It doesn't have to be major, but it can be enough of a financial setback that you're suddenly now tapping your savings sooner.
Yeah.
So you owe it to yourself to think about that. A lot of people are quick to buy life insurance, and that's fine, but you're much more likely to become disabled. So if you're actually going to give me the choice, I'd say take the disability, because if you're dead, at least you're not consuming. Now, granted, your heirs are going to be in trouble, and that's another issue. And so life insurance has its place. But if you can't work, financially, it's worse than death, because you have to keep consuming. So
it's less expensive to be dead. That's what you're saying.
Just be mindful. The last thing I would say as far as taxes is you're going to see, in my opinion, dramatic changes in the tax code over the next few years, regardless of who wins. And the simple reason is because with the baby boomer continuing to move into retirement, the burden on the federal treasury just keeps getting bigger and bigger and bigger. We just printed massive amounts of money. You're going to see changes in the tax code. You need to be up to date on those. So make sure that your financial advisor is constantly making you aware. There's a lot of things you can do as a self-employed person. There's a lot of things you can write off as a self-employed person that you couldn't if you were a W-2 employee. You need to know what those things are so that you're minimizing the tax on yourself.
Yeah. Yeah. And they change every year.
They change every year, and they're going to change very fast now. Yeah. Because we got so many issues that we're dealing with. This whole COVID thing is going to be, it's going to be leaving its mark for quite some time.
Yeah. Yeah.
I feel.
Yeah. Wow. Death, taxes, financial advice. I tell you, here's the thing, right? Is that this is probably going to end up being the most downloaded episode we have, because what we're talking about is so basic and fundamental, and yet so infrequently talked about or implemented. And what I hope is that, those of you that have heard it, heed his advice and get this stuff taken care of. The next thing is forward this to your broker, to the owner of your business, whatever it may be. If you are not a realtor, but have friends that are realtors, send this to them. And it is amazing what you may save them, and honestly, what you may earn them by them listening to this episode. Dan, I just want to say thank you so much. First of all, for bringing your wisdom on the show, but second of all, doing it in an entertaining way and being so succinct and concise with your advice. And I, your demeanor is fantastic. And I appreciate that people can listen to this and be entertained and also learn a ton. So thank you.
No, it's my pleasure. You infuse the energy in me, so I just had to follow.
Well, thank you so much. I appreciate that. And listeners, viewers, I appreciate you. Thank you so much for doing what you've done with Referrals Podcast. If you haven't reviewed us or rated us at iTunes or Google Play or Stitcher, do us a favor, please, and do that when you get a second. We always appreciate it. There are new people all the time coming to Referrals Podcast. They do read your ratings. They do read your reviews, and they are going to listen to it based on what you say. So thank you so much for doing that. We try to provide value every single week, every single time that we do a Referrals Podcast. And do us a favor, go to referralspodcast.com, check out the downloads. Here's our promise. Not only do you get the downloads from today's episode, but you get the downloads from every episode we've ever done. You get all of them in one fell swoop, and I will tell you, you will be addicted once you start seeing the downloads. And ladies and gentlemen, thank you so much. Check out referralmasterysummit.com. This is coming up very, very soon, referralmasterysummit.com. It is for anybody who wants referrals, who wants repeat clients, who wants to build client retention and client loyalty, but also wants to get lots and lots of referrals. You're going to be hearing from record-setting salespeople and record-setting business people on how they do it, and they're going to give you the recipe for referrals at the Referral Mastery Summit, referralmasterysummit.com. Check it out when you have a second. Thanks, everybody, for being on Referrals Podcast, and we'll see you next time. Thank you so much.